This is Bloomberg Markets. I'm John Erlichman with Taylor Riggs, and President Biden hailing the tentative agreement between U.S. railroads and unions after they reached a deal to avert a work stoppage and threaten the U.S. economy. Let's keep that conversation going now. Pete Earle joining us now, an economist at the American Institute for Economic Research. It was getting awfully close, Pete. What's your reaction to everything we've learned today?
Thanks for having me. Well, I mean, this dispute really goes back to 2019. There were a lot of delays and posturing along the way, but I would say overall the unions pretty much got what they wanted. There are some, this still needs to be approved, but I think for now, pretty much a major threat to the economy on top of the inflation numbers we saw earlier this week has been averted.
What are you learning, though, about the fragility of these supply chains in this inflationary environment?
Yeah, so I mean, over the past few years, we've seen virtually every link in the supply chain either bend or break, right? We still have lingering problems with ocean shipping and with trucking, but rail was actually the last one that really didn't show any major problems. Rates rose a little bit, but not as much. So with the unions, if they went on strike, the last most feasible means of land transport would have really seen the cost to ship goods rise exponentially. I mean, really, it would have been a huge blow to the economy if that had happened.
Clearly, there were multiple factors to get worked out, and we've talked a lot about that, Pete. But earlier this hour, Sarah House of Wells Fargo talking to us about the longer inflation stays elevated, the more conversations we are going to see between companies, industry, and labor unions. And I wonder what you're watching for on that front.
So most collective bargaining agreements have a cost of living allowance built into them, and typically they involve some use of the CPI or some range, within maybe 0.5% one way or the other. But I mean, we've had a substantial rise within the last year or year and a half. So I think what you're going to see is any collective bargaining agreement that comes up is going to be, there's going to be a higher risk factor, especially if that industry is significant on a macroeconomic level of problems.
Big picture, coming off of the CPI data that we got this week, the retail sales that we got this morning, how is the health of the consumer in this inflationary environment?
It's a very mixed bag right now. We shouldn't be surprised that the economic numbers look strange because we're coming out of a very strange environment with the pandemic. But one thing I would say is that we have a very strong jobs market still. There's still almost 2 openings for every individual looking for a job. And in addition to that, consumer sentiment, which was dipping, seems to have rebounded. And we still have a lot of savings. There's still a lot of people who have savings from the stimulus payments and all that sort of thing. So consumers are okay for now. But that can change pretty quickly, and it has in the past. Typically, unemployment and all the bad features of recessions tend to happen up to a year after we have the dip in GDP. So there's still a lot of time to figure out what kind of situation we're in.
Pete Earle, economist at the American Institute for Economic Research, really appreciate your time and your perspective there.